Hello and welcome to Cargo Short, brought to you by Old Dominion Freight Line. I'm your host, Jonathan Betz, and today we are tackling the issue of how to keep domestic supply chains operating during disruption. In 2022, we've continued to experience global supply chain challenges and the effect it has had on the American economy. Propelled by the pandemic, many organizations were forced to re-examine and manage their supply chain to ensure business continuity and growth for the future. Today, we are here to discuss future strategies on how companies can maintain supply chain resilience and the lessons we've learned to help companies avoid disruptions. Joining me now is Chip Overby, Senior Vice President, Strategic Development for Old Dominion Freight Line, and Professor Jeffrey Bergstrand, Professor of Finance in the Mendoza College of Business at the University of Notre Dame. Thank you both for being with us today.
Happy to be here. Thank you.
Thank you for having us.
So, Chip, let's start with you. This is something we are all hearing about right now. Product shortages, labor issues, shippers having problems getting their product to market. So give us an overview. Where do things stand when it comes to the supply chain?
Well, I think you could probably say it's a little choppy, maybe at best. The supply chain's always got some ebbs and flows, and I think you got to start with a little bit of perspective. Throughout, whether it's the domestic supply chain or the global supply chain, you've got potential bottlenecks, right? We've always had that. It's just that when the pandemic came along, it sort of highlighted how the world was interconnected, and it dramatically exacerbated those bottlenecks. You fast forward to now, it's probably better in some places. We're not where we were pre-pandemic, but there are probably some positive in some places. But you mentioned some things that they're causing some issues. We got some labor concerns at the ports and in other places. I mean, you can't even go to a restaurant and not have a labor consideration. And then we've also got inflation. Then you have weather events, and all those things on their own probably doesn't create what we have. But when you put them all together and you put them in the equation, as you add things like a hurricane down in Florida, that just changes things. So, if you look at the ports, I was talking to some of our folks that run the operations we have in our ports, and some of the things they're seeing, they're talking about the labor shortages. They're talking about situations where the ports are trying to manage between unloading the vessels and loading the truckers. But that balance creates some drag downstream, right? So if your trucker's in there and he's waiting or she's waiting 45 minutes, that's one thing. If they're waiting 3 hours, well, now you're eating into the driver's time and time to the DC, and do they run out of hours? And all that just continues just to work its way downstream. So that's an issue. I did hear, or I saw on a KeyBank Capital Markets note last week, that the LA Long Beach ports were down. The volume was down about 18% year over year, but keep in mind, 2021, the ports were really backed up. And they're down sequentially about 13% since August. So those things themselves may help catch things up a little bit. But again, you still got the labor issue of, okay, what do we do first? Do we unload the vessels? Probably so, because there's a cost of not unloading them. And then how do we get the truckers in and out? So I think that's kind of where we are right now.
So not in the clear yet.
No, sir, we're not in the clear by any stretch, but hopefully it's improving, and we see some of that, on a day-to-day basis.
So Professor, Chip mentioned those ports and, of course, overseas manufacturing, which is leading to the big question of, are we going to see more companies reconsider their offshoring strategies?
Yeah, I think the short answer to that is yes. I mean, this has been, the last 3 years, incredibly unusual time. I think, we think of these ups and downs, but, what that raises is the volatility going on and the uncertainty going on. The way I think how firms are going to respond, I mean, we typically talk about firms, maximizing profits, getting a high return on capital and on investment. But we also need to recognize that firms consider uncertainty. I mean, the analogy is we think about investments, our own investments, any investors out there. You want a high return, but also to get a high return, you have to take high risk. So risk and return are both relevant. So when we look at, this is, I think that uncertainty factor, that risk factor is really important when we talk about global value chains and including the domestic end of that. I think, firms want to, we've gotten into this situation because international trade has shown us that we can take advantage of specialization. We all specialize. Jonathan, you specialize in what you do, Chip in his skill area, and myself in the academic environment. So we want to take advantage of specialization. But to do that, you have to rely on international logistics. And I think the interesting thing, if we just look at the last decade prior to 2020, we had this period of incredibly stable, low inflation, kind of manageable relative prices. We had an environment where health concerns globally were under control up until 2020. We think of Ebola and Zika, and some of those were all manageable. It was just 10 years ago that Xi Jinping came into office in China, who started changing things around. So we had this very stable environment. Then all of a sudden, we have high inflation, and with high inflation, you have variability and more uncertainty. You have this differential responses around the world by countries' governments to the COVID crisis, creating a shock to costs and uncertainty. And then, we have the oil and gas crisis created by the Russia-Ukraine war, and we really don't know how long that's going to last. And now we have Xi Jinping moving more in an authoritarian direction in terms of government policy and creating uncertainty about the U.S.-China relationships long term. So all these things combined create huge uncertainty that firms have to deal with by reconsidering their offshoring situation and perhaps pull more towards diversifying that and onshoring.
But how hard is it to diversify that, Professor? I mean, it cannot be easy to move these investments from China, as your example, to other parts of the world.
Yeah, it is. And that is, I think, so what I would say is in response to that, the changes are not going to be overnight. It's going to be a very slow response. I think the factor economically that I always think about is just the fixed costs involved in changing your logistical situation in the global value chain. I mean, a really good, simple analogy to kind of that creates that resistance to changing quickly to this environment and so creates inertia in the system is we think about oil prices and gas prices going up. And you might think, well, why aren't, say, U.S. firms, we have domestic oil and domestic gas that we can produce, why aren't they responding more? Well, there's a very inelastic supply in the very short run. They can't respond. They don't have the capacity. It takes a while to build that capacity, and that requires covering new fixed costs in order to respond. So that creates inertia in the system and why these things won't change overnight. But I'll also add another dimension, a part two to that, and that is the timeliness right now. We are imminently in a recession in the United States. We are likely to be in a global recession. The Federal Reserve in our country, central banks around the world, industrialized countries especially, are raising interest rates. We know the outcome from history is that's going to lower demand. So there will be some easing in the problems associated with the global value chain. Some of that will be easing simply because demand in the economy and economic activity will slow down, and Chip even referred to that in some of his earlier comments.
Well, back to the offshoring strategy conversation here. Chip, I mean, what are you hearing from shippers on this issue? Are they looking at trying to bring their manufacturing closer to home?
Well, we do hear some, but again, I think I would use the word perspective in that, Jeffrey's exactly right. I mean, these companies have spent a lot of money, and there's a huge capital investment that they have offshore. So being able to do that quickly, depending on what agreements they may have with the country or the labor workforce or wherever they may have there. So we are hearing more about it. But there's an ROI and a justification for doing what you're doing in those countries. And as the interest rates go up, your hurdle rate for making that thing happen changes, right? So, I did read an article back in June, I think it was, from Industry Week, where ABB had polled about 1,600 executives in Europe and the U.S. and asking that very question, hey, look, are you looking to move things more onshore or nearshore to the U.S.? And this is what they said. 70% of the companies are looking at or planning to reshore or nearshore. 37% said they plan to return production to the U.S. 33% are looking at nearshoring, and 40% are looking at robots and how they can go about offsetting the cost of labor in those nearshoring or onshoring operations in order to drive down that cost and make it more feasible and sensible to do those things. So, again, I think there's a lot that's got to happen. I think people are realizing what happened in the pandemic, that, hey, kind of like we talked about earlier, this interconnection could be a little bit more dramatic than what people realized. And for so long, the inventories that these companies had rested really on the vessels or on the trucks. The huge warehouses, particularly in the U.S., don't exist like they used to for, entire U.S. It's regionalized or localized, and the e-commerce world drove that, right? So if you think about e-commerce maybe from a global perspective, e-commerce is nothing more than JIT on steroids. And the premise behind that is get as close to your customer as you can get. So maybe down the road there's going to have to be some type of a hybrid type thing. Maybe that's I do this percentage of my business overseas and I do this percentage onshore, nearshore, and we're using the offshore as the beginning of the supply chain to support the closer DCs and maybe amping the amount of inventory that you keep there. But again, your cost is in your inventory a lot of times and not your transportation.
So with that in mind, Chip, as you point out, this is extremely complicated. There's a lot of parts to this. Onshoring manufacturing is one part of it, but it's a big investment. It takes a lot of time. So what do you think are some of the key requirements to ensure that domestic supply chains operate efficiently?
Well, as I think about that, I think there's probably three things to consider up front. One is proximity and the strategic inventory management. And I was kind of alluding to that just a little bit ago. Maybe a hybrid approach is something that we need to consider and look at. Not to say that a lot of companies aren't, but there again, maybe that's an option. It's possible that maybe we need to get some of this inventory closer to who the end user are. Again, that's part of the whole just-in-time or e-commerce model. How we better control our own destiny. I will tell you here at Old Dominion, as an aside, we run all of our line haul or movement from between service center to service center ourselves. A lot of carriers don't do that. They outsource that. Well, we don't outsource it because we want to control it, right? We want to have controlling interest of where our customers' goods are. And I think that's something we got to consider. Capacity and technology, I think, is going to be a big consideration. In many cases, the capacity could be limited due to labor availability. Again, I mentioned that poll from ABB earlier. Maybe that capacity and that labor and the ability to drive that capacity, maybe there's technology involved in that. Maybe technology they're not using today or new technology we got to use. I think, too, with that, there's a little bit of a sense of urgency. There's an old proverb that says, build the well before you're thirsty. And in this case, we need to probably spend some time making sure we're looking far enough down the road, because the reality of it is there's wisdom in preparing for the inevitable, rather. And nobody expected a pandemic. Nobody expected what was going on in Russia and the gas, right? So things like global political unrest or those type of things, you can't predict it, but you got to try to sort of plan for it. And I think if we look at the proximity of where we're manufacturing and where we're getting delivery, how we drive capacity, there's 2 or 3 ways to do that, and then having a sense of urgency about, hey, look, let's don't let this happen again 20 years from now. It may take a decade to change it, which I wouldn't disagree with that at all, but we shouldn't be here in the same position 20 years from now.
So, Professor, what do you think? What needs to be done to build that well before we get thirsty?
That's a good question. Well, the first thing that kind of comes to mind is this diversification aspect. There are the typical firm, when we think about the global value chain, often has very limited number of suppliers that they work with, and it's partly related to those fixed costs and setting up that network. If we talk about it internationally, you have to think not just the logistical costs and the cost of transportation, but also you need to think about interacting, networking, language differences, cultural differences, managing all those things. Those are tremendous costs in the process. So they often, have just a couple of suppliers. I remember an anecdote about following the 2011 earthquake in Japan, the Fukushima province. And there was only Ford and Chrysler had only one supplier for a type of paint that was generated to create sparkles in the paint process. And when they got shut down, slowed down tremendously what could happen in terms of that. So what that suggests is that they need to think about more multiple suppliers to get that diversification to I think that's a big part of building the well in advance.
But obviously it cannot be easy to find new suppliers or change suppliers, and I can't help but think of smaller American companies, manufacturers, and what they might face in trying to either move their operations closer to the States or find varied suppliers, Professor.
Yeah, it is. Small and medium-sized producers and firms always have it tougher than the larger ones. And, again, when we think about a smaller firm, you have to get that size in order to cover some of these fixed costs. In the long run, you have simply the costs of logistics itself, the fixed costs associated with setting up those relationships. Smaller firms face higher costs in terms of international insurance costs, financing costs. All these things make it harder for those smaller producers to be successful. Now, no question, the falling costs of transportation, technological innovation in terms of global trade management have helped smaller producers get into the exporting field and develop their global value chains. So all that is important. The technology is just really important to helping some of those smaller producers. But also, one other thing, I just want to follow up on what Chip said about what Old Dominion emphasizes the service to service, and that kind of control from the service to service center was a really interesting point. Because when you think about the truck labor shortage, this is becoming just a persistent problem. So we put it in the context of the labor force, and so many workers in other areas are working 2 to 3 days in the office, working from home. And now you have truckers on the other side facing these huge demands and the consequent shortage there. So these are, I think, even bigger problems for smaller firms to have to deal with. And having that quality control in the shipping and the line from service center to service center, I think, is really advantageous.
So, Chip, I want to get your response to that there. What do you see as some of the critical requirements for carriers to provide reliable, on-time service to customers, especially considering all these obstacles the professor just mentioned?
Well, he's exactly right. There's a lot of things to consider, and there's the equation of how you put it together makes sense. Again, I can tell you what we've done here and how we look at it, and I believe is the right way to look at it, and I think our results have proven that. The reality of it is we can't serve our customers unless we have the capacity to do so, right? And we look at capacity 3 different ways. We look at it as labor, we look at our network, and it's our equipment. So we have really invested heavily in our network to build capacity, i.e. doors, service centers, that type of thing. We've spent well over $1 billion in the last 4 years just on our network. That didn't even count the equipment. Our CapEx this year was a little over $300 million just for the facilities. So you got to have that network capacity, right, to process the goods. The second piece is you got to have equipment, right? You got to have the equipment to move the goods. Now, if you got the money and you're physically able to do it and financially capable of doing it, then those two probably aren't the hardest things. However, I say that, but the equipment today is a little bit of a problem because it's hard to get equipment today. It's no different than a car, right? I read an article the other day that said, "Hey, dude, where's my car?" And basically it was, we'd love to give you a car, but we can't get all the chips and the products and stuff to make the car. The same thing's true with equipment that we buy, be it trailers or tractors right now. But we invest a lot in that equipment. The last piece of the capacity part is the labor. And it's exactly what the professor was talking about. So we have made a conscious effort to make sure we're doing the right things to have the labor, because if you talk to the ATA, and particularly their economist, Bob Costello, they'll tell you we're pushing a 250,000 person labor shortage for truck drivers. You just can't go to a manufacturer and say, give me 1,000 truck drivers. It doesn't work that way. So we've got to convince people what a great industry this is, what a great company we are to work for, and manufacture them, some even internally. And we do that today. And I think the last piece is you've got to have technology to help you drive this. The fact of the matter is we can't change the distance of the goods that we haul, and we can't change the speed limit. But what we can do is plan better and know better and exchange data better and have a conversation in the corporate boardrooms with our customers about, hey, what are you doing here? What's your strategy long term? Where are you trying to get to? Where are you placing your facilities where you're trying to get your customers? How do we help you with that? Let's talk about this thing a little further than just, hey, what's your freight rate for next year? Because at the end of the day, that's not going to solve the problem. Problems are going to get solved by communication and talking and building this information into the infrastructures.
Well, Chip, I want to go back to that point you were saying about equipment because I find that fascinating. Yeah, we all see the shortages. It's hard to find a car right now, but I don't think a lot of people realize that applies to companies and big players like yourself. So talk about a little bit more what you are doing to try to get around this equipment issue.
Well, listen, there's a lot of technology in the tractors that pull our trailers. There's a lot of technology at our place in our forklifts. I mean, we joke here sometimes that the cheapest thing about our forklift might be the forklift. So this technology in those cases or in the tractors, there's a lot of computerization. There's a lot of safety features that are built into these tractors now, and it's all run by a computer or some type of chip that's restoring from night to night or day to day or transmitting information back to our corporate office to give us data. So if the car companies are having a hard time getting chips, well, chips are being made from a lot of the same people in a lot of the same places, and exactly back to what the professor was saying a minute ago. This diversification of who can do it and where are they.
So, Professor, what do you say to that?
Yeah, I'd like to focus for a minute on the semiconductor chips and follow up on that comment because, we have to think about how to do that. Some discussion at the national level, of how we should handle that, almost along the lines of defense-related act issues. And it raises some interesting questions. We've had episodes, and I'm old enough to remember back in the 80s, about putting quotas in certain areas as a matter of protecting security at the government level. But what in the end, I think most economists say we do need to rely on the market. In other words, we think about those 5 steps that Chip mentioned, 5 issues that are very important for success in the global value chain. Firms are on top of these things. They are flexible enough to respond. And especially now with technology and automation and artificial intelligence that can help solve, along with big data, solve these problems, they can solve a lot of these in real time. And if we do create, an environment with too much regulation in a particular industry, you don't have the flexibility of firms to respond fluidly and adeptly to the problems at hand. So I think when addressing the semiconductor issue, yes, we need diversification, and I think that firms are on top of it and have to deal with that at a very decentralized level.
And that goes back to our conversation about decoupling from Asia, certainly when it comes to semiconductors and the reliance on tech. Let me also ask you, Professor, about the e-commerce trend here, certainly driven by the pandemic. Everyone's shopping at home, buying all sorts of things. What impact do you think that had on the supply chain, and are those impacts here to stay?
Yeah, so what comes to mind was when Chip used the term e-commerce is like just-in-time on steroids. I see it exactly the same way. I see what e-commerce has done. So consumers and younger generations are used to all this technology and dealing with things and acquiring transactions, making transactions on a very fast basis. And e-commerce is part of that. You just don't have to move from the couch, say, for a customer to buy something and set off the entire global value chain for that particular transaction. So it's really kind of magnified everything in terms of managing inventories. It's made it more challenging for this industry and for all that are involved in the freight moving process. But they've also responded. And I think back in terms of the last time that global Baltic freight values went up as a share of GDP in our economy was just during the time of the oil crisis of the late 70s. But other than that, they've been going down over time as this industry has responded with combining in a complementary way labor along with the physical capital that's needed. And we talk about hybrid models. That's something to keep in mind, that human capital and physical capital in solving these problems are very complementary in nature, but that I trust the firms to be able to adapt to it, given how we work as in a free market, largely free market economy.
So, Chip, talk about how you guys have adapted to this. I mean, has this surge towards e-commerce during the pandemic made business more challenging?
Well, the trucking industry is not necessarily a complicated business. It's very much a precise business, I think. Hey, look, it's a challenge. I mean, if anybody told you that in 2019 we were going to be dealing with some of the things we were in 20, I'm not sure any of us would have guessed that. But I think what really helped us here at Old Dominion was we had spent time building the right culture here of how to help people, building the notion of how you deliver a promise and how you go about doing the extra things and going the extra mile, if you'll excuse the pun there. And we had built capacity. We'd been doing it for years, with not only within our network, but within our fleet. So I think we had the components of the right things, and then we've got the right culture here for how we communicate, how we talk to our employee family members, and that's how we managed it. It was a day-to-day, sometimes hour-by-hour communication of, okay, what do we need to do next? What do our customers need? What are they capable of doing today? And how do we support that? And that's how we managed through it. It just was a constant communication effort, and we used a lot of technology. We've spent a lot of money on technology here. We probably average somewhere in the 20 to 40 million a year on the CapEx side for technology. So all those operational technologies we put into place and the planning tools, they were a big, big influence on how we managed that process.
So, Chip, as we wrap up here, give us an idea of kind of where we're looking at in the future here. Do you think we're ever going to get back to the years before the pandemic, or is this our new normal?
Personally, I don't think it's the new normal forever and ever. I mean, I'm like the professor. Look, at least these corporations are smart. Walmart didn't get to where it is because it doesn't know what it's doing. So they're smart. They'll figure it out. They do have big data. They do have technology available to them. They'll put all that to work, and this will get figured out. I mean, I'm an optimist by nature when it comes to stuff like that. And look, this country, in my opinion, is the best country in the world, and it is for a reason. We're not always right, but when it comes time to get together and do the right things, we usually do that. But I think it's going to take some more time. I don't think we're out of this by any stretch of the imagination. Again, back to the article of a reference about, hey, dude, where's my car? They're saying, hey, maybe. The article said maybe this is another year or two before that whole car production and you being able to walk on a lot and choose what you want gets here. Now, this inflation may help that in that people may not be able to afford brand new cars, right? Because they can't pay the interest rate on a brand new car. So it may not be the way you want to get there, but it may actually help drive some of that, whether we like that or not. So, but no, I don't think this is going to be this way forever. I think we'll figure it out.
And Professor, final thoughts, do you agree?
Yeah, and I'll just say two things. One is, it's unfortunate that the only way we know in economics and macroeconomics how to alleviate inflation, given very low unemployment and wage price spirals, is to raise interest rates. And it's the unfortunate thing that we have to create during the short term more unemployment to kind of ease pressures, and that will help alleviate some of the strains on the global value chain issue. So I agree. And then the broader point, I believe in business to solve these things. We faced this last 3 years just an incredible time. Business has adapted as much as it can, but I'm optimistic. And again, I look at the notion that if you look globally for the global value chain, that the cost of shipping products has fallen 50% over the last 60 years. That it may not drop that much over the next 60 years, but I'm confident that it will stay low because of innovation and technology and the excellent human capital that we have in leaders that are leading businesses.
moving in the right direction. Well, there is certainly no doubt the pandemic disrupted supply chains around the world. It tested the resilience and flexibility of supply chain leaders globally. While COVID-19 was not a typical risk event, it certainly underscored the need to think about supply chain challenges now and in the future. Thank you both, Chip and Professor Bergstrand, for providing your expertise and some valuable insights on ways to mitigate domestic supply chain risk and how to better protect supply chain capabilities. That is going to do it for us today. We want to thank you for listening. If you enjoyed this episode, be sure to check out the other podcast as part of the Cargo Shorts series. And for other information and materials on this topic, visit the resources section of the Old Dominion Freight Line website at odfl.com.